Good morning to everybody who is joining us today from the US. Good afternoon, whoever is joining us from elsewhere in Europe and in other countries in the South Mediterranean and Africa. I welcome you all to this EMEA webinar. It is the third of the EMEA webinar fall cycle. So we started already since September after holidays, and this is the third one. And this is a very important one because we are discussing the reforming of the international debt architecture. Can debt transparency be achieved in Africa? So this webinar is organized to launch the Euro-Mediterranean Economists Association EMEA Transparency Debt Initiative, which is aimed to enhance socioeconomic research and open access knowledge about sovereign debt related issues, the links with investing and financing infrastructure development and development as a whole, and also the pillars toward debt sustainability essential for sustainable development in the Mediterranean and in Africa. So this effort could not be more timely. So when we started the thinking a few years ago, we didn't have all this debate about debt relief, restructuring, and so on. Especially it has been accelerated by the COVID-19 pandemic. So let me share with you a very quick background over the few last months. So in April 2020 communique, the G20 announced an agreement with the Paris Club, a group of major creditor nations, to freeze some debt payments for the 77 poorest countries from the 1st of May to the end of 2020. When requested, of course, by eligible countries to free up cash for the pandemic. So really to help those countries to mitigate the socioeconomic consequences and hardship of this pandemic. So this initiative was extended, in fact, a few weeks ago for another 6 months till June 2021. And we think it's going to be extended even further. The IMF has been very active in mobilizing billions of dollars in emergency financing through the rapid facility, a credit facility instrument, and in some cases also by increasing the size of pre-existing programs, such for example in the case of Angola. Also through the private sector involvement element of the debt service suspension initiative, which in fact this was the initiative pushed by the G20 with the official creditors. Private creditors also were asked to share the burden of suspending some debt service payment to eligible countries requesting such a relief. So of course the take-up of the private sector involvement that are countries in fact who have borrowed money requesting the suspension of commercial debt service obligations have been muted to a certain extent because some of the eligible countries were afraid for potential downgrades from rating agencies, but also could find their market access completely cut in the meanwhile. So within this persistent COVID pandemic, and of course the dire global and regional economic outlooks, we've seen it over this past few weeks, especially in the eve of the IMF and World Bank Group annual meetings. More African countries have really been transitioned to a very high risk of debt distress, particularly, for example, the case of Zambia. We've seen it over the past weeks, and surely we will discuss about it today. And some of them, in fact, including Zambia, has started its reprofiling of debt. Now, the IMF, a couple of weeks ago, they launched a call to reform the international debt architecture. And we will discuss it also later on. And the IMF has put very strong emphasis on debt transparency. And this is the core point of our discussions today. Now, with these elements, they will guide our discussion today. I'm very honored to welcome this very impressive lineup of distinguished panelists, all working from different perspectives on sovereign debt-related issues. And the moderator, Alonso Soto, who is a Bloomberg Nigeria correspondent, and all the participants who have registered in the webinar. So before we start, I would like to share with you some logistical information because before I hand over to Alonso, webinar contents and discussions are public and are live broadcasted on Facebook. So EMEA team later on will publish a recording of the webinar on our website and a report that summarizes the main discussion points. For the participants, please write your questions and comments on the Q&A box and the panelists on the chat box, so you have it there. So we can start now. The objective of this webinar, and I repeat, is to discuss the role of debt transparency in reforming the international debt architecture. The discussion will be focused on Africa and tackle issues like sovereign default, debt relief measures, the role of international organizations such as the IMF, maybe the European Union, if there is a role there, the OECD, the World Bank, and also the private sector involvement and the potential path toward debt sustainability via transparency and conditionality. So let me hand over to our moderator, Alonso Soto. The screen is yours, please.
Wonderful. Thanks. I hope you guys can hear me. Can you hear me fine?
We hear you with an echo, so if you can be closer.
Take a look in here. How about now? Can you guys hear me a little bit better?
Okay, more or less.
Yeah. So we're going to start anyway. I want to welcome everybody, the participants, and also everybody who's watching us right now. I will keep this introduction short, and hopefully you guys can hear me. And one thing before, I just want to clarify that I'm actually in Madrid, but I'm usually based in Abuja, Nigeria. So the conversation today will be extremely important and timely. For years, there have been calls from different sectors of society to increase transparency in sovereign debt. And now, finally, the coronavirus crisis seems to be opening a window of opportunity to bring some clarity to the sometimes murky world of debt. Transparency is especially important in Africa. The continent has seen its debt landscape change dramatically over the last 15 years. There are new players that are taking over from old creditors. Bondholders have replaced commercial banks, and China is taking over the lead from the Paris Club as the main bilateral lender. Today, the IMF released economic projection for the continent.
Alonso, we are receiving comments from the audience that they cannot understand what you're saying because of the echo. So probably you could find solution connecting via your mobile phone like yesterday. I think that might be.
I'm wondering if you guys can hear me better now.
Oh yes, now it's much better. Yeah, let's talk and then we will see what's the issue, because some problems of this nature happen from time to time with the Zoom platform.
Well, very good, guys. Oh, my apologies. I'm just going to resume transparency. We're talking about transparency, and transparency is especially important in Africa. The continent has seen its debt landscape change tremendously over the past 15 years. There are new players that are taking over from old creditors in the continent. Bondholders have replaced commercial banks, and China is taking over the lead from the Paris Club as the main bilateral lender. Today, the IMF releases economic projections for the continent, and the outlook doesn't look good. Sub-Saharan Africa will just grow 3.1% this year, falling behind other regions for a continent that until recently had some of the world's fastest growing economies. Even before the pandemic, more than a third of African countries were approaching or already experiencing debt distress. One of the main issues will be financing for these countries amid the pandemic. Transparency could help cover that financing gap. African government officials and some academics have complained that Western bias has kept African yields unfairly high. Investors and rating agencies say transparency can help lower that spread, narrow that spread. It can increase the appetite for African debt. It could also help speed up future debt restructurings with more countries now struggling to repay its debt. However, the challenges are tremendous. The disclosure of oil-backed loans in places like Congo, Brazzaville raises a lot of questions about financing from trading companies. The same goes for China, with commodity-backed loans to places like Angola, Ghana, and Zambia. In Zambia, the situation is especially delicate as the country moves closer to default. Bondholders are complaining that Zambia needs to reveal its true exposure to China. Beijing, on the other hand, says Western private creditors should follow their lead and give the poor countries relief. Transparency is at the heart of that conflict, a dispute between creditors that could mark a new chapter in the world of sovereign debt. Momentum for a change in the global financial architecture is picking up, and the debt relief initiative pushed by the G20 could help. But there is also a big question about the capacity and the willingness of many African countries to open up. Corruption and wasteful spending could help fuel further discontent and political instability in the continent. The massive demonstrations in Nigeria that we're seeing these last few weeks is a reflection of that. So on that note, I wanted to start the conversation, and I will hand it over back to the professor with a very brief introduction. So Professor Laryea Ayadi, she's the founder of the Euro-Mediterranean Economists Association. She's a senior advisor at the Center for European Policy Studies, a professor at the Business School, City University of London. She has very ample experience on sovereign debt, and she's leading this drive for the debt transparency platform. So with that, Professor, you can take over.
Thank you very much, Alonso, for the introduction. And I hope now we have no issues on the technical side, so we hear you just fine. So my remarks will cover mainly two aspects in the next 7 minutes to 10 minutes. First of all, is the increasing sovereign debt in the middle and low income countries and the current efforts of the international community to respond collectively within this global pandemic, the COVID-19. So this is a very important aspect because with this global pandemic, we've seen that the global community is collectively responding to this problem of the accumulation of debt. My second point is to share with you is the main proposal of a recent policy paper I co-authored with my colleague Emilius Abougleias, who was supposed to be with us today, and I'm sorry to say that he had some personal issues. So this paper was published at the G20 T20. So the T20 is a think tank 20 of the G20 group. In which I was a member of the International Financial Architecture Task Force, and this paper has been published. So I will share with you the main proposal of it to enhance transparency at a global level, but with a focus on low and middle income countries, and all the African countries and also South Mediterranean countries are part of this group. Now, the ongoing developments, the COVID-19 pandemic has caused a lot of detriment, widespread concerns about debt insustainability in both developed and also emerging markets, and obviously countries of low income and middle income countries. Now, looking at the most recent report from the IMF, in fact, published for the World Bank and IMF annual meetings on the 1st of October, since the end of 2019, the average 2021 debt ratios are projected to rise by 20% in advanced economies, 10% in emerging economies, and 7% in low-income countries. Now, these increases come on the top of already very high levels of debt by data of 2019. So more debt will only enhance the risks in the financial system, especially if the restructuring and the defaults are not managed in advance. And obviously that is why the debt service suspension initiative has been one of the key responses of the G20 since April 2020. Now, looking at the advanced economies, they still have some capacity to borrow. Why? Because of very low interest rate yet, and very low risk premium. Now, emerging markets and low-income countries face much more tighter limits. They are not prepared to borrow more, and then also have the capacity to pay this debt, the old debt, and obviously a new debt. We've seen, for example, the case of Zambia now, Argentina, and most probably others will have to follow in the same spirit. Now, in their paper, the IMF have called for urgent need to reform the international debt architecture. Very interesting proposals they made on the eve of the annual meetings. Now, where those reforms will go, we don't know yet, but clearly they were pushing for more debt relief. Second, to strengthen the contractual provisions via the extension of the collective action clauses to non-bonded debt, enhanced by, of course, the clauses that lower debt payments or automatically suspend debt services, such as, for example, in the event of natural catastrophes or large economic shocks. So it means that it becomes more, I would say, extended to all type of debt. This is quite ambitious by the IMF. Now, also to enhance debt transparency to facilitate restructuring and resolution decisions and actions. This is extremely important because, you see, transparency is key to know what is the overall stock of debt you have from, for example, the Paris Club, from the private creditors, from other types of creditors like China, India, Russia, and others. And all these, what I call creditors, have to accept to provide more transparency, and also the countries that are receiving or borrowing, they have to show their books in a way, in a very open manner. And of course, we know very well that this is not going to be an easy task, especially for countries in low and middle income countries. At the same time, the World Bank Group has published very historical, in fact, for academics. I'm an academic, so we always love data. I mean, we work with data, we cannot. And they published a very interesting debt data, they call it international debt data for 2021, with unprecedented level of granularity. I mean, when I saw it, I was very happy. So that's great. I was even looking for the names of the counterparties, but no, that's too much. I think I'm dreaming with that. So and this publication is very much welcomed indeed, but then it will support the research community, but on a consolidated basis. We cannot go deeper, but then it's the one step in the right direction. Now, of course, the debt service suspension initiative needs to have more monitoring of where the relief is going, and this is extremely important to have granularity also in terms of the creditors who have accepted to provide this type of relief. I think this is an important aspect also of transparency. But also for IMF and the World Bank, they called multiple times, and they even showed multiple calls for the participation of the private sector or the private creditors in this debt relief effort. Now, the private creditors are rather reluctant to participate, first of all, because there is a widespread lack of transparency. And at the same time, there are other aspects related to some losses and also some the aspects that I mentioned previously. Now, I would like to mention, and I'm very happy to have today Sonja Gibbs with us from the from the Institute of International Finance. They were very pushing for this and committed for the voluntary principles for debt transparency. Now, of course, now debt transparency becomes a priority in the international policy agendas. And of course, we know as academics that debt transparency is essential to limit the information asymmetries in the market, but also is essential for public governance and accountability. What has been done, in my view, today is good enough, but it's not sufficient. So we need to go further in terms of transparency. And our proposal, which I will share with you in a minute, is to go a step further and implement the public global mechanism for recording old and new sovereign debt issuance to boost global debt transparency from all sides, from the private creditors, from the official creditors, but also for the countries that are borrowing themselves. So this mechanism can take the form of an independent, open access, real-time, tech-driven debt transparency platform. And actually, we are, as I mentioned, we are researchers, so we developed it. And I can ask my colleague Kinga to show the platform, which is now running. But of course, you know, it'd be interesting to take it forward and fill it with data. So and we based our structure basically on the voluntary debt principle of the IAF, which, in my view, gave a very good, you know, starting point to structure such a platform. Now, this platform later on it should be powered by a blockchain technology, so a distributed ledger system where bilateral, multilateral, and private sector players can register on time their sovereign debt transactions. And there, of course, this will lead to more transparency in the sector. But of course, you need to have this happening, and we need to study more how to implement this blockchain technology. So, of course, Emilios today is not with us to talk more about the specificities of this blockchain technology. But also, in the paper, we think that this registry could move in the long run to become even a trading platform for debt in the secondary market, probably. But again, more research needs to be done to see how it could be implemented. So this is what I call second phase and the third phase. Now, for now, this platform should take the form of private-public partnership, serving as a global registry, as I said, aiming at filling the gaps in newly issued sovereign debt, specifically for these countries in lower and low income and middle income countries. It should also serve as a, say, I would call it energize the public fund management and also boosting the technical assistance effort of the IMF and the World Bank and others. So it's really, with data, you are able to see, for example, what are the best practices, what are less best practices, and so on. And this will help also the World Bank and the IMF to enhance their technical assistance efforts to help better manage the public funds for infrastructure development or for development as a whole. And also could facilitate the restructuring and relief involving private sector creditor. Because then when you have the whole information, so it becomes easier to restructure, and this limits the cost, and this limits also the economic, socioeconomic cost of messy defaults and unorderly restructurings and resolutions. It helps also research organizations like ours to develop further knowledge about debt-related issues. And finally, it could be a very powerful tool to reduce corruption and also public debt mismanagement. So this is all. I think we're not going to debate this, the importance of this facility, but as I mentioned to you, this is, we need much more data, granular data by counterparty, and then obviously this will help the process of the international reform on debt architecture. So I would stop here, Alonso, and then I'm happy to take some questions later on. Thank you.
Very good, Professor. I'm just going to make a brief introduction of our next panelist. That's going to be Sonja Gibbs. Sonja is the Managing Director and Head of Sustainable Finance, Global Policy Initiatives with the Institute of International Finance in Washington. Sonja leads the IIF policy work and sustainable finance and infrastructure investment, including advocacy. So Sonja, the floor is yours.
First and most importantly, unmute yourself. The cardinal rule here. Thank you very much, Alonso. And let me just say, Rian, that the platform that you've built is spectacular. There's so much that's gone into that. So many congratulations on that. And looks like there's lots of scope for taking it forward in different directions, including with new technologies. And so well done as a first pass. I wanted to cover three things in my intervention today. First, to give a little more context around private sector participation in the DSSI. Second, a few comments on the IMF's proposals for a common approach to debt treatments beyond the DSSI that Rim mentioned. And that'll all form the basis for this proposed common framework. And third, an update on the debt transparency principles repository and the road ahead. So to start out with, it's clear that the pandemic has completely made obvious that there's a real need for structural reform in sovereign financing for low-income countries. And one clear problem is that many emerging and low-income countries just can't provide the necessary fiscal support for a crisis like this one. So in that context, the G20 debt service suspension initiative for the DSSI is a critical part of helping these countries, and the 6-month extension is a very welcome development that'll provide much needed liquidity for eligible countries. Just a few words about private sector engagement in the DSSI. As some of you will know, there's been a fair amount of criticism as to why the private sector isn't stepping up to the plate. And the short answer is in part, for the most part, that borrowers are not asking their private creditors for debt relief. Grenada did, then rescinded, and Chad has asked commodity trader Glencore to suspend payments. Zambia sent a consent solicitation, as was mentioned, but the vast majority of the eligible countries have not asked. And I think it's important to note that most of these countries don't borrow in private markets. So really, you're only talking around 25 eligible countries. So why haven't they asked? And this kind of boils down to trade-offs, right? Commercial borrowing arrangements are priced and rated, as Moritz, I'm sure will comment on later, either internally by lenders or externally by the credit rating agencies. And when you ask your private creditors for debt service suspension, it puts the credit ratings at risk for downgrade. There isn't a way of getting around that, short of doing an outright taking over of the ratings process, or the methodology of credit ratings. The independence of this methodology is very important. It's a key component of how financial markets operate. So if your credit rating is at risk of a downgrade, that increases the cost of borrowing and ultimately putting market access at risk. And I think it's important to stress that access to private capital is only very recent for many low-income borrowers, and they had to work hard to earn that access. And we've heard from many borrowers, including via the United Nations Economic Commission for Africa, or UNECA, that borrowers don't want to jeopardize this market access. So the trade-off for them isn't worth making. But the second reason why there hasn't been much in the way of formal private sector participation in the DSSI is that it just doesn't work well as it's structured for the private sector because of the way loan and bond contracts are structured, the great diversity of the creditor base, fiduciary considerations especially for bondholders, and how market access works. But I want to stress a really important point here. We have a private creditor working group that has over 200 members. It's one of the most active working groups that I've ever seen in my over a decade at the IIF. And there's tremendous enthusiasm. In fact, one of our panelists today, Laryea, is part of this group. Huge enthusiasm for finding ways to help. Most of them, we did a survey of these creditors. We've done a couple of surveys now, and here's a few kind of takeaways from what they're saying. Most are actively engaged in discussions on ways to help to provide assistance with debt service to DSSI eligible countries, and much more broadly, there are many vulnerable countries that are not eligible for the DSSI. So I think this is important. You can look at what's happened in the cases of Ecuador, Belize, Suriname. There's a specialized Africa private creditor working group working directly with individual borrowing countries. A lot of lenders are continuing to disperse under their existing loans for ongoing projects in the areas of infrastructure, COVID-related budget spending. Some are working with multilaterals like MIGA with a specific focus on the healthcare sector. So there's a lot being done outside the context of the DSSI specifically. On the bondholder side, a lot of them are participating in new bond issues, including for some DSSI eligible borrowers like Honduras, and others are actively engaged. And I think this is a really interesting and important point. Many are talking with groups like UNECA, talking with the multilaterals on coming up with alternative and cheaper financing structures to help address short-term liquidity needs. And many, many global investors, we see this increasingly, are looking for more consideration of climate and related environmental sustainability factors in debt solutions. So for example, SDG-aligned bond funds, partially guaranteed SDG bonds, or debt for nature swaps, and all of this is directly relevant to the context of this pandemic. So lots of ways to approach debt service suspension and debt relief more broadly, but for the private sector, there is no one-size-fits-all approach. And that's been one of the difficulties with the DSSI, because it is a kind of a one-size-fits-all approach. So turning to the common framework, or the IMF paper that will underpin the common framework, I want to stress that we've not actually seen the common framework itself. What we have seen is this paper proposing a common restructuring approach across all official bilateral creditors, including China. And the paper sets out options to improve debt transparency and what they're calling debt treatments beyond the DSSI. So we're moving squarely into the realm of restructuring here. So the IMF notes in the paper that the existing international architecture for sovereign debt restructuring works reasonably well, and that enhanced collective action clauses, or CACs, have helped restructurings go more quickly. Is there room for improvement? Absolutely. A lot of the debt stock doesn't have CACs. That's a problem that's just going to be resolved over time. And non-bonded debt, in other words, mainly loans, syndicated loans in particular, don't tend to have majority restructuring provisions. So that means more case-by-case bespoke restructuring, which is one of the problems that this paper is trying to address. I think there's an underlying concern that if there were a lot of debt restructurings needed all at once, that the system just would implode, that couldn't handle it. And I think we would argue here that there's ample capacity to work within the existing system, to work through restructurings on a case-by-case basis. If I can just get in a little kind of plug here for the Principles for Stable Capital Flows and Fair Debt Restructuring, which emphasize good faith negotiations, the role of the creditor committee, and enhanced transparency. So those principles have been around for over 15 years now, and they're very frequently referenced in debt restructurings. They're an integral part of the overall architecture for sovereign debt restructuring. We feel it's very important that any kind of reforms or changes to the architecture build on the principles. That said, there's a lot that can be done to improve the framework. So wider adoption of collective action clauses is important. Getting non-Paris Club creditors like China on board and on the same page is key. More clarity and structure around lending by state-owned enterprises is very important, and transparency on all sides. Rim mentioned this, Alonso, you referred to it. Critical, essential. I'll get to that in a minute in my final points here. The paper recommends that all official bilateral creditors, Paris Club or no, agree to a common approach on restructuring official bilateral debts with a common term sheet requiring debtors to transparently lay out debts. So far so good. That's an admirable goal, and admirable and ambitious and challenging. And then the term sheet would also sort of proposes comparable terms for official and private debt. And this is where you run into some of the same difficulties that we've encountered in the DSSI, the difficulty of determining what is comparable treatment. If you think about sort of net present value neutrality, NPV neutrality, for example, that differs, the parameters of that differ considerably for public and private sector creditors. But the bottom line, I think, that I'd say with reference to this evolving common framework is that there should be an open and constructive dialogue about how to build this framework, and that private creditors should be consulted in this process so that it works well for all sides, because public and private creditors absolutely need to collaborate if there's to be effective resolution for the debt problems ahead of us, and that there be transparency on all sides, cards on the table. And I want to stress here that any kind of top-down or coercive or mandatory approach to either liquidity or solvency problems would be highly counterproductive, driving up risk premium, constraining market access, and ultimately hitting private capital flows to these vulnerable countries. So finally, let me just reference the debt transparency principles, and very happy to take any questions about these. The DSSI, I think one of the key things it's done is underscore how important transparency is when you're trying to address debt problems. You can't resolve a problem if you don't fully understand it. And that's the key thing about transparency. So the voluntary principles for debt transparency, which are supported by the G20 last year in Fukuoka, they're designed to, first of all, I should make it clear that the scope is private sector lending, right? So these principles, there are other constructs, the G20 operational guidelines for sustainable financing that govern or that push for transparency on public sector creditors and borrowers. That's not the scope of these principles. These principles are targeting the private sector. To PRGT countries, the most vulnerable low-income countries eligible for concessional financing. And so the underlying goal is that greater transparency should facilitate good governance and aid the fight against corruption and support debt sustainability, all key goals. So just a couple of key points about the principles, and then I'll end here and turn back over to you, Alonso. The principles, the voluntary principles, are a multi-stakeholder initiative. What do I mean by that? I mean that everybody's got skin in the game, all right? So private sector lenders, official sector entities, everybody's got this shared interest in debt sustainability, investors, civil society, journalists, like Alonso, citizens of borrowing countries. They're all increasingly active advocates of transparency. The principles are a global public good, and they should have shared public-private sector governance. And this is going to be affected by our group of trustees of the principles for stable capital flows and fair debt restructuring. The principles are absolutely going to rely on collaboration and engagement with our official sector partners, with donors, with civil society, other stakeholders. It's important to note that the only way this can be accomplished, this debt transparency for the private sector, is to have voluntary submissions. The private sector lenders and the public sector borrowers, so the sovereign borrowers, they must agree to this transparency. So that's super important to note, right? There is no kind of supranational world power that can dictate transparency. There has to be consensus that this is what we want to do, and agreement on both sides. Borrowers have to agree to make their disclosures, their transactions transparent, and lenders must do the same. So to make that happen, you've got to have kind of official sector steer toward this. So the principles are going to require sustained official sector support, including from the G20, the Paris Club, international organizations, and the international financial institutions. So a quick word on scope. The scope of the principles is private sector foreign currency lending to sovereigns, sub-sovereigns, and public sector entities, the PRGT eligible countries. And it's key that they're intended to capture any transaction that has the economic effect of borrowing, so including loans, guarantees, asset-backed lending, repos. It excludes publicly traded bonds because disclosure in those markets is judged to be adequate. And we have a recommendations on a set of disclosures around interest rates in ranges, maturity, use of proceeds, and so on. The principals will have a secretariat, and a lot of those functions will be carried out at the IIF. We've got to make decisions about what the scope is and the interpretation of principles over time, because this is an ongoing initiative. Critically, we've got to socialize and promote these principles, because if they're not well understood and if the information isn't out there, then you can't build the support and adherence. And the one key function of the Secretariat, of course, is to promote adherence and give visibility if borrowers wish to have it. And finally, just on the governance, the principles will be overseen by the group of trustees, and a representative from a repository would be invited to participate in the governance as well. So I'll stop there and happy to have any questions.
Very good. Thank you very much, Sonja. Now I'm going to give the word to Thomas Laryea. He's a lawyer with Orrick law firm. He's an expert on sovereign debt restructuring with a special interest in Africa. Thomas formerly served as Assistant General Counsel at the International Monetary Fund. So with that, Thomas, you can take it away.
Thank you very much, Alonso, and I'd like to thank the organizers for this opportunity to participate in this important webinar. Thank you. I feel that this is an historic time for sovereign debt, particularly for low-income countries, many of which are facing extraordinary challenges as a result of COVID-19. One of the tests of history that we're facing will be whether we can collectively engage in the right responses in order to cushion low-income countries from the negative economic and human consequences of COVID-19 during this crisis containment phase, but to do so without driving these countries further back into dependency on other governmental and intergovernmental agencies over the longer term. I will say more about this big picture issue during the question and answer phase of the webinar. But given that my time is short, I'm going to use the rest of my time to drill down a bit further on the issue of debt transparency. But I need to start by recognizing the IIF for its leading work in the area of sovereign debt more generally, and specifically on the voluntary principles on debt transparency. Sonja and her colleagues have worked persistently to push the debt transparency initiative and have creatively overcome many an obstacle. As we approach the breakthrough with regard to the repository, I think that it's important not to overlook the issue of official sector claims against sovereigns, which of course are not covered by the IIS voluntary principles on debt transparency. Such official sector claims remain the most opaque channel of sovereign debt. Ask anyone who is involved in the ongoing Zambia case, and they will affirm that for you. As I understand it, the debt transparency platform proposed by the excellent paper by Professors Ayadi and Abgulas is intended to cover both official sector and private creditor claims, which is an important extension. Okay, let's talk a little bit more about what we mean by debt transparency. In my view, there are at least 4 different levels of debt transparency. One is transparency about the existence of the debt. Second could be transparency about the terms of the debt. Third, transparency about the identity of the creditor. And fourth, transparency about the use of proceeds. These levels are often conflated. Clearly, the existence of the debt and key terms are the most basic aspects of debt transparency. Local regulations that require parliamentary approval of types of public debt, for example, foreign currency borrowings, play an important disciplining and transparency role in this regard. While I recognize that the application of such laws in some country situations have exacerbated governance problems, these parliamentary approval laws are generally helpful. The identity of the original creditor would commonly be a key term of the debt, so that will be disclosed through those key terms. But one should not overlook that the creditor can change through the legal assignment or novation of the debt, and if the debt is a tradable instrument, tracking the creditor at any one time can be difficult in practical terms. Furthermore, when we say the identity of the creditor, do we mean the nominal creditor or do we mean the beneficial interest holder? Again, the latter can be difficult to identify because of legal and practical reasons. Transparency on the use of proceeds is, to my mind, the most difficult aspect. This is one aspect that a number of civil society advocates have implied will be enhanced by debt transparency initiatives. However, given that money is fungible and much of government borrowing is for budgetary purposes rather than tied to specific projects, identification of the use of particular borrowing is an uncertain exercise at best. Moving on to another general point. The more that a debt transparency repository intends to go beyond merely housing the debt contracts for public review, the more legal and practical problems arise. For example, the idea of excerpting or summarizing in the database the key terms, as is proposed by the debt transparency platform, can require legal and financial expertise to execute. any contract can be subject to multiple interpretations, and who would take or disclaim responsibility for such excerpts or summaries? A host of regulatory questions can arise in terms of financial disclosure and market integrity rules, the more one pushes the functionality of the disclosure platform. A thought on incentives. Incentives are critical to motivate debt transparency. In this regard, my friend Professor Anna Gelpin of the Georgetown Law School has argued that so-called hidden debt should be unenforceable. One may be able to reach a legal conclusion of unenforceability to the extent that the debt is contracted in circumvention of a mandatory law and parliamentary approval, as I just discussed, or if there's fraud entailed in the contracting. But the conclusion of unenforceability in both these examples may need to be litigated in any given case, and the outcome of that litigation may take many years. But for sure, a serious risk of unenforceability would incentivize disclosure and adherence to other related formalities on the contracting of debt. A less stringent consequence that would also incentivize debt disclosure is the subordination of hidden debt relative to disclosed debt. Such subordination would be particularly meaningful in the context of a debt restructuring, ensuring that the creditor recovery of the hidden debt is subordinated to recovery of the disclosed debt. The Mozambique debt restructuring has aspects of both unenforceability and subordination consequences of hidden debt. But how would the subordination consequences of hidden debt be reliably implemented in the absence of a sovereign bankruptcy law? Sovereign debt restructuring is essentially a negotiated process around some legal, policy, and market principles. I consider that at least bilateral obligation between a sovereign debtor and its creditors can be included in a particular debt instrument towards the effect of subordination. For example, a non-pari passu clause that establishes that undisclosed debt will be paid only after payment of the category of debt recognized in the relevant debt instrument. Just as established market practice in sovereign debt tends to exclude from sovereign debt restructuring short-term debt with maturity of less than 1 year or trade-related financings, market practice can also evolve to establish expectations of subordination. So going forward, we should consider whether an update to the IIF's principles on fair debt restructuring could reflect the notion of subordination of hidden debt in the future. A couple of more points, please. The World Bank has also sought to influence incentives for low-income countries to strengthen institutional frameworks for public financial management, including debt transparency. The World Bank's Sustainable Development Financing Policy sets aside certain percentages of allocations of concessional financing depending on policy actions in public financial management. This illustrates an approach in which multilateral financial institutions are influencing some aspects of debt transparency through their conditions or their lending policies. I recognize that in the recent review on the reform of the international financial architecture for sovereign debt, the IMF signaled a revision of its debt limit policies to support debt transparency. But I have to say, I do not understand the content of the potential changes by the IMF, and that proposal remains highly fuzzy at this stage. One last point in relation to the G20 debt service suspension initiative. We've heard today that the DSSI requires that the beneficiary country commits to disclose all public sector financial commitments subject to considerations of commercial sensitivity. Frankly, it is not clear to the extent to which this commitment in relation to debt transparency has been carried out across the 40 or so countries that have received some DSSI from the official sector. Indeed, because the DSSI refers to an expectation of technical assistance from multilateral agencies to achieve this, I would say that the debt transparency is cast as a capacity building objective rather than a firm commitment for today. In sum, there are many overlapping initiatives for debt transparency. Improvements in the transparency of public debt is in the interests of countries in Africa and other stakeholders. But I would underline this final point. Such transparency is in the interest of all countries, and it's important that we not just focus on Africa or low-income countries when we consider further reforms in this area. Thank you.
Very good. Thank you very much, Thomas. Now we're going to go with Funsho Allu. He's the founding partner of TIA Capital, a sub-Saharan African investment management business. Before TIA Capital, Funsho headed the EMEA hedge fund business for IAG Investments and PineBridge Investments in London. So with that, Funsho, go ahead.
Hi everyone, am I coming through clear? Good, excellent. So my views are my own. Dr. Ayadi and the EMEA team, thanks for having us. TIA, to a certain extent, co-organized this call, but EMEA has done all the heavy lifting, especially from an intellectual standpoint, so we're glad to be included. Thank you. So we're all IMF watchers on this call, and just to give you a couple of views around the questions asked of us, which is what do we think about the IMF's proposals, and what do we think of the potential for the debt transparency portal to actually be effective. Starting with the IMF side of things, we think the IMF, in its documentation and in recent comments by the MD, accepts that the existing contractual framework has been largely effective in restructurings around sovereign bonds. But clearly the recent cases in Argentina and Ecuador demonstrate that there are issues that still need to be addressed, caused by A, I guess, the significant expansion in the diversity of commercial creditors over the past few years, and B, I guess, the lack of debt transparency, which is a topic we're all going into today. In Sub-Saharan Africa, we posit that the IMF and the other financial institutions' mistrust is really centered around a geographical issue when it comes to bilateral creditors, should we say, to be diplomatic, and then also collateralized debt or debt with collateralized sort of features, which I think Alonso mentioned in his introduction. Prepayment structures, countries like the Republic of Congo are being targeted for the resolution of some of that uncertainty. We internally at TIA, and I think we speak for a lot of the IF members that we coordinate with actually on the Sovereign Debt Committee, is that we're of the view that the established principles of debt restructuring still work pretty much as they should, and the perceived inefficiency of the process is a natural outcome from the complexity of the stakeholders that are involved in all of these restructurings. These restructurings, the inefficiencies in these restructurings can be improved, but we don't really think they can be eradicated. And so the noble aim that the IMF and some other parties have of eradicating these complexities can actually create a hostile environment for the investment of private capital and a reduction of attractiveness of some of these markets. So we hope the IMF and others supporting their views in the recent report are being careful about that. CACs, for example, have been a useful tool in the past decade or so in enabling organized restructurings. But the conditional clause is supported by recent academic work that we've seen from the likes of Lee Buchheit and Mili Gulati will need to have a lot more detail attached to them to efficiently calibrate any conditionality that's inserted ex ante in bond and loan documentation. We just need to take into account the varied debt compositions and the varied macroeconomic frameworks that exist in the different countries in sub-Saharan Africa. These conditionality elements, which I think Dr. Ayadi touched on as well as Sonja, make it really hard for private investors like us to price credit. And so as a result, that may reduce access to liquidity from the market, especially from, I guess, the benchmark community. At TIA, we do both sort of private and listed structures, so maybe we're a bit more in the weeds in legal documentation, but I think any increased complexity could make it hard, especially as the developing markets and developed markets are competing for capital on a risk-reward basis, and will do so in the next few years going forward as we work our way through the crisis. It may seem counterintuitive, while the IMF, works on these proposals, we welcome the IMF Managing Director's recent vocal support at the annual meetings for a case-by-case approach. She actually said that, for now, that is the way to do things. And we very much agree that that makes sense. It's something that IIF and the private sector have been advocating for throughout the year in our general resistance or rebuttal of the blanket comparable treatment requests and proposals from the G20 and others. It may seem counterintuitive, but observing the lack of success of PSI in the form posited by the G20, World Bank and others, the private sector and Africa's finance ministers generally seem to be on the same page with respect to comparable treatment. We've seen varying projections for the funding gap for Africa going forwards, and we think it's very hard to give an exact figure on this. But over the next 1 to 2 years, we don't think the entire burden for closing the financing gap in Africa can be closed by the international financial institutions, and therefore the private sector needs to be incentivized to stay at the table and to help out as we go forward. It's our view that any blanket repositioning of the sovereign debt restructuring architecture could reduce appetite in a world where capital is going to be tight going forward. Now, contrary to some common assumptions, the private sector is actually very supportive of increased transparency, and the debt transparency platform has a lot of support from our peers. It's been somewhat involved with EMEA. Sorry, I froze for a second. Can you hear me? Good. TIA has been somewhat involved in the development of the debt transparency platform, playing second fiddle to EMEA, and we're very glad to have supported this initiative. But the important, selfishly, the platform is really important to us, as we have live examples in the recent past on our continent where sovereigns have really paid the price for lack of transparency. One example just behind us, and I think Thomas will attest to this, is the case of the $2 billion worth of hidden debt in Mozambique. And one example just ahead of us is exactly what's happening in Zambia today, which we've all commented on separately in this conversation. So Zambia, if we take for a second at a high level, has been in discussions with the IMF since 2016, 2015 about the program. And it's really had issues around the transparency of its debt with respect to infrastructure loans, defense loans, and all of these things have created a certain amount of mistrust amongst creditors, both bilateral.
I think we lost Funsho. Hello? Wondering if he froze. He's out. Let me see him here. So I think we're gonna give it 1 second to see if he can reconnect.
Sorry, where did you lose me? I'm sorry about that.
About a minute ago. So go ahead.
Oh, good Lord.
A little bit less than that.
Well, investment in internet in Mombasa is definitely needed at some point in the near future. Okay.
We're talking about Zambia, the creditor mistrust that we're seeing there at the moment.
Absolutely, absolutely. So where was I? Collect my thoughts. Yeah, so one of the issues and one of the reasons why Zambia has taken so long to secure an IMF program, we feel, having had contact with the fund and also with the administration, is that there's a certain amount of mistrust around its sovereign debt base, its debt stock, right? Issues with transparency around its project loans, its infrastructure loans, defense loans, and others have created that mistrust. And for us, increased transparency at the point of debt contraction would have really helped issues such as, for example, the classification of ZESCO debt as whether it's been independent SOE project-based debt or whether it would have been implied sovereign debt. We saw a situation a couple of years ago when the IMF in its Article 4 pulled a lot of ZESCO debt into the circle of sovereign debt and essentially upped the stock as a surprise to private investors. That kind of thing would be avoidable if we had something like the debt transparency platform in place. As a private investor that really sort of focuses on the debt sustainability framework and its metrics, one of the things that we really like about the debt transparency platform is the fact that we'll get an idea of maturity profiles in some of the sovereign debt. Because if we're looking at the debt sustainability framework against a backdrop of present value calculations at the point of our investments and whether or not there's fiscal space to take on new debt, it is important for us to be able to calculate what that PV is, and we can't do that without understanding what the maturity profile is going forward. So the sort of information that is given to the IMF and the like and helps them to make decisions, given that, because obviously they're printing this stuff in their Article 4s, given that we as private investors will also be making loans to sovereigns and want to be able to make the same credit-informed decisions, having that sort of information in the transparency platform is also going to be very helpful. I'll make a point which is trite, but I think we've all made it. I think it's important to make it as a private investor, is that transparency in this sphere aids good governance by giving both civil society and investors a clearer understanding as to how government funds itself and what it uses the proceeds of that debt to do. Getting a clearer picture, I don't think any of us on this call will argue, is worse than where we are today. And briefly answering the final point that was posed to me, we think that greater transparency actually can be achieved in Africa, but there are a few caveats to getting that done. You can't force this on anyone in a formulaic fashion, so the voluntary element's important. But if things are voluntary, there tends to be a slower speed of adoption. And so we need to make sure that we bring, from an Africa-centric position, collectively focus on bringing African voices into the governance element of the debt transparency platform to make sure there's buy-in and people move towards supporting this. And we also need to integrate with some of the current IFI capacity building initiatives that exist to get a comprehensive view of the debt stock and get the database as relevant as quickly as possible. The same issues that we've seen historically with the IMF trying to get, for example, an accurate view of the debt stock of Zambia, we need to be able to sort of get up the curve as quickly as that with this new initiative as well. I'll leave my comments there. Sorry for the interruption, internet, and I'll answer any other questions in the Q&A.
Very good, Funsho. Thank you very much again. Our next speaker is Moritz Kraemer. He's the Chief Economist and Advisor of Acreditus. It's a risk consultancy, as well as the independent and non-executive director of Scope Ratings, a Europe-based rating agency. Until 2018, he was at S&P Global as the Sovereign Ratings Group Global Chief Rating Officer. So with that, Moritz, go ahead.
Thank you, Alonso, and congratulations to Rim and the group for this report, which I want to say a few words about. I think I call that blockchain debt database for lack of deeper understanding of the technology about it. I think its time will come. Whether it has come yet or right now, I don't know, but it just seems to be an obvious solution to an intractable problem, because the tolerance for swiping debt under the carpet is really running thin with more and more market players. We had sort of examples from Greece to Mozambique. We just heard about China in Zambia and other countries. So the transparency is becoming actually a fundamental credit factor here. So I think your proposal is very well taken. There is momentum right now. Whether it's technically feasible, I'm in no position to judge, but I think it's fair to assume from my observation of market participants from both sides that without sort of the debtors sort of letting their pants down, the creditors should not be expected to provide relief, because they will feel that they're being taken for a ride. So data transparency is a precondition for future efficient debt restructuring and resolutions. And as I'll show in a moment, delays are very costly. I think what would make the data transparency more powerful in a second stage is to create an index. I think just some people just love indices. It's a lazy analytical tool. I've been working for almost 2 decades in a rating agency. Part of the success is based on the fact that you have these indices of creditworthiness which are easily comparable. Or look at the World Bank governance indicators. If you ask anyone what is governance like, 99% of the time this is where you go. So having an index of transparency is very powerful, because it also increases the incentives to become more transparent once the transparency is transparent, if you know what I mean. So this is the incentive structure is very important, and I say a word about this towards the end of my remarks. But it's in line with what Thomas was recommending in terms of possible subordination of the undisclosed or hidden debt. So incentives do matter. But the data in itself is just the first step. The transparency of the data is good, but you need to use and apply it also in qualitative analysis. And here I'll say a couple of words about the potential role that credit rating agencies could play, which are very much quoted in this episode now for fear of default, etc. So they're playing a quasi-regulatory role, which are not really meant to play, but this is just a market convention. So one advantage of having sovereign ratings in the frontier countries, which is still sort of fairly patchy in terms of coverage, is that you have regular reporting and you have regular fundamental opinions being voiced. For example, in sub-Saharan Africa, what you could see is that there have been downgrades in my old shop at Standard & Poor's since 2013. So the slide in credit quality is not recent. It's not related to COVID. It's just brought things to a head. So this is an advantage of rating agencies because they publish regularly their opinions. Whereas, the sell side, they will jump in both feet first when you have a big bond being issued. The one episode I still remember is when Gabon came out with its first bond in 2007. You suddenly had like 15 very thorough and deep sell side analyses, exhorting the strengths and the attraction of Gabon. And then once the bond was issued, you've never heard of any of them again. So I think this is something in terms of transparency, which is suboptimal. So rating agencies in that perspective are quite good. And they say that data transparency is important. Actually, I just counted it. There's like 10 times the word transparency appears in the S&P methodology, 17 times in Moody's. So they do matter. Actually, when you think about how sovereign ratings started in Africa, sub-Saharan Africa, it was actually an initiative by UNDP early in the millennium, when they paid 5 or 6 sovereigns to get a sovereign rating for 2 years. S&P won that tender, and some of them still do it today. So none of them had issued bonds, but it was a measure to try to create transparency. And I think if we have this data of debt transparency, this could be leveraged through this process. And maybe one can try again what was done at the time with UNDP to do a tender like for sub-Saharan African ratings, which may be subsidized by the multilateral donors and partners, but it would have to be linked to surveillance criteria. For example, what my former colleagues no longer publish a sub-Saharan Africa report, which is, I find, mind-boggling. They just sort of summarize it into sort of emerging markets. So create this transparency by sort of guiding also the rating agencies to provide sort of the right transparency on what they do. So on the fear of default, I think it's much overdone. What we've seen is that not many countries have applied for it, for public sector involvement in the DSSI, but that's understandable. I mean, these countries do a cost-benefit analysis, and there is a cost to default. And then they have to compare it with what is the price. So the price that they, or the quid pro quo that they get is a couple of months of debt service relief along the DSSI guidelines. So this cost-benefit analysis is just not very attractive because the benefit is quite low and the cost is comparatively high. But actually, it's not so high as people normally think. And here's why I think that the fear of default is really exaggerated. It should not be the rating agencies and the declaration of default, and it's true, it is unavoidable. Any restructuring is a default. It's almost impossible to avoid this. But the market access loss, I think, will be pretty limited and in times, and I think much of the talk is a little bit as a protective argumentation by the buy side. First thing I would say, the market access for all intents and purposes has been lost already. The last bond issue that I'm aware of in sub-Saharan Africa was in February before we had the pandemic. So the market is closed. Another reason is that after a restructuring, the ratings actually may be higher of those sovereigns, and therefore, as they should be, because they're safer, and that might actually pave the road to market access. We also have to keep in mind the unprecedented liquidity and the desperate hunt for yield of investors, which we've never seen before. So I would be very surprised if investors were sulking in their corners and saying, we're not going to go back to Zambia or Ghana or wherever, whoever might restructure in the future because they once restructured. I think that's not going to happen. It's also I think to be very much important to remind ourselves that what we're seeing now is not the result of a mismanagement of public finances or macroeconomic policies. This is not Argentina. This is a global external shock which hits everyone in all our countries. We're all sitting at home because you know, we can't go to proper offices and things like that. So this will not be held against sub-Saharan African sovereigns the way the default is held against Argentina. Investors are not silly. They understand the difference. And I would argue that it should be done quickly and preemptively. There is empirical evidence, as far as there can be with so few observations, that a preemptive restructuring leads to lower haircuts on average. And if you have lower haircuts, you have shorter market exclusion. So I would think that if we sort of go ahead now, the market exclusion would not be such a big problem, especially since we have it already now. I think investors would come back pretty quickly if they sniff the yield and they recognize that, you know, the signaling of this restructuring does not mean there will be another restructuring down the road because the country can't manage its finances. This again is not an Argentina type. So I'm pretty optimistic that this might actually happen, because as it seems, and Sonja can correct me, but if I read the last letter of the IIF president to the G20, they seem to be coming around to accept that for more and more countries, this is an issue of solvency rather than liquidity. So the second sort of transparency element and sort of index type element is what can the multilaterals do? I would say that an instrument that in principle I like is what the World Bank has been doing for a good decade now, which is debt management performance assessments. So they analyze including transparency of the debt, but it's terribly technical and it's sort of not really comparable across countries very well. And the frequency is just not sufficient. So there's always a trade-off when you do these reports between depth and frequency. I think the World Bank gone fully for depth and just do it every 10 years or even just once. I think if we have sort of more regular updates on how the debt management operates in terms of operational efficiency, but also transparency, the better, and the better the incentives will be. So talking about incentives, one last observation from my side before I hand it back to you is, you know, some of the examples that we've been talking about here, Zambia, you know, Mozambique was mentioned. You know, we can observe that there are incentives from both borrowers and lenders to hide some of the debt. I think that's undeniable. You know, sometimes it may be attractive for all sorts of reasons, which I don't want to go into because it gets pretty messy pretty quickly, but I think you know what I'm talking about. So the debt managers in the country and the decision makers, they need to have skin in the game. And how can you do this? Well, this is just sort of a thought I want to put to you, and probably it needs a little bit more refinement, but we can take a leaf out of the practice of executive pay in listed companies in the US and elsewhere, where sort of leading executives are actually only paid partly in cash and partly in stock options, which are, you know, which grow in value if the company is well run. So analogously, you could give policymakers some variable pay in liquid government assets, for example, with a vested period where they can sort of get or redeem that after 5 years or something like that. And if in the 5 years the whole thing blows up because they've been hiding too much debt, their pay is lower. Or you get a deferred bonus if the debt transparency indicator or index improves or things like that. But give them skin in the game. There's little that focuses the mind as much as a financial incentive. I'm not aware that this has been tried anywhere, and of course there are lots of technical problems with who's responsible for what, but we need to overcome the incentives to play the intransparency game, both on the creditor and on the debtor side. I think the debt database that you're proposing is a good step in the right direction, but in a next step we need to use it to create additional sort of consistent incentives with transparency, and then future workouts, if they ever have to happen, will be less traumatic because they can be done quickly. And as I mentioned, if you have a quick workout The haircut will be lower, the financial and social crisis in the country will be less, and market access will be restricted for shorter time. But the more intransparent it is, the longer it takes, and that's the time inconsistency of incentives that we're facing right now. Thank you.
Thank you, Moritz. And our final panelist, that will be Kwame Barnieh. He's a partner at KPMG in Ghana. He has nearly 2 years of experience working in international auditing and risk assessment and management. So with that, Kwame, you have the floor.
Sure, thank you. So I just want to thank Dr. Rim and all the EMEA team for inviting me to be part of this panelist. It's interesting listening to everybody, and depending on where everybody sits, I think puts out some good arguments for this whole transparency discussion. I mean, for me, let me just say that I've read the paper that Dr. Rim and team has put out, and say congratulations. It's a very good one. Like everything else, I mean, from everything that we're hearing, I think there's a lot of things that are being done with regards to debt service management, and also transparency seems to come out as a strong point. So I think there's no denying that is a critical or important point. Now, let me bring it to Africa, or Sub-Saharan Africa, to be very specific, and even tie it into the maybe some goals that have already been set in terms of looking at ending poverty. If you look at some sustainability goals that have been defined to end poverty in 2030, I mean, it's clear that it's not sustainable, even without COVID, right? So COVID is a new dynamic that everybody's talking about, but even without COVID, it appeared not to be sustainable, because infrastructure development alone would require about 4.5% of, and if you look at how much these countries in Sub-Saharan Africa are kind of put out in terms of their own resources, it's not that much. And there's a lot of payments in terms of interest, medium interest payments that's kind of have grown about over 100%. I mean, from 2013 onwards till now. So there's clearly a difficult challenge in terms of development in Africa. So the point is that debt transparency is one pillar which is going to help this whole process. And what are my thoughts? My thoughts are as follows. There has to be a collaborative approach to this whole thing. And if you listen to the panelists, and if you listen closely, I think everybody has a perspective based on where they work or so there has to be that collaborative approach where everybody comes together to think through it and see how it will actually be operationalized. The second point I really like has to do with the key stakeholders. I mean, the World Bank, IMF has been, and the G20, I mean, has been at the helm of trying to drive these debt service arrangements. I think it's important for the debt managers to be held accountable and to contribute to how they will demonstrate proper accountability. And I really love the point that Thomas made about the different levels of transparency, where he spoke about the use of funds. If you use a credit agency or put a risk premium on a particular debt, once you give it, what that money is actually used for is sometimes lost. And that's probably the most important thing, because if it goes to build something proper, at the end of the day, it helps improve the country's ability to develop or to do better in the next time that they are borrowing, right? So that level of granularity with regards to the transparency is important. Looking at the creditors, so I think a point has been made clearly that there's an emergence of other creditors or private creditors who are participating, and I think the point has also been made that we need them. We need them to close the gap. So who are they? What are they offering, and how can we really hold them accountable? Now, with this whole point about holding the debts accountable has to do with this whole PPP thing, where it is a big point made across a lot of African countries and a lot of developing countries about PPP. Now, I mean, what is it? I mean, what is it for all of us? When it comes to this debt transparency, I think Dr. Rim's paper, if you study closely, kind of talks about using technology to drive this whole thing. The point was made about how do you capture the data, and I think I've also heard a lot about making it voluntarily, submissions, and which I agree to an extent. But the point is that how do we motivate all these stakeholders to provide the right data, provide it on time, and leverage appropriate technology through this kind of private public partnerships, because the data and the information sits with everybody. Now, my final point, I mean, with regards to using some firms like ours and maybe to drive that sense of accountability or independence, I think that there has to be a process where disclosures are properly defined at the onset as to how do you disclose things as a country, how do you disclose things as a creditor, and how are these things validated? We need a consistent framework of validating it so that it kind of corrects that whole voluntary part. So even though it's voluntary, you have some sort of assurance on what is being put out there, and everybody can kind of rely on this information to say that this information is good and is going to really promote what is being put out for. So thank you. I'm going to leave it here, and I'm going to just wait for any questions that's specific to some of the points I've raised. Thank you.
Very good. Well, thank you very much, guys. That was a very interesting set of presentations. I know that, well, I want to make this as fluid as possible so everybody can jump in, can ask questions. I know that Sonja has to leave relatively soon, so she's going to be the first in the line. I'm sorry about that, Sonja. And the first thing that I want to ask you is, you know, we saw last week the decision from the G20. You mentioned the common framework for restructurings. We know from our reporting that there was some opposition within the G20 from China, India, and Turkey to this common framework. At the same time, it was agreed there needs some domestic approval, but this is raising optimism that China could be brought into the fold, that they could open up and they could coordinate better in upcoming restructurings. I wanted to ask you if you believe that China will join in full. You know, can we expect China to coordinate with the Paris Club and therefore opening up the way for dialogue with private creditors, which is a problem that we're seeing right now in Zambia?
Right. Well, I think as a first pass, I'd note that any effort like this to establish kind of a supranational framework for something as complex as debt restructuring is going to be challenging. All countries will approach it from different angles. Newer creditors, as you point out, like China and India, don't share the same kind of history and experience in dealing with these issues, so they'll have their own sort of perspectives on it, which has been the challenge, I think, in structuring a framework that is traditional, that goes along sort of Paris Club guidelines, but also can be readily encompassed by newer creditors. So I think those discussions are going to continue. And it's a question of sovereignty as well, right? So I mean, in order to make any modifications to doing things in exactly your own way, if you're China or India, you know, that requires a great deal of discussion and thought. You ask whether they'll participate fully. I mean, you know, if I have the answer to that, it would be I'd be doing something much more lucrative than what I do now. But look, I think there is every incentive for non-Paris Club creditors to stay at the table, to participate in discussions, while retaining the independence that they need, that they want. So I think that there will be acceptance. I think they'll get this sort of common framework through. Then it will come down to the interpretation of it. You know, how will it work in practice, and how will China and other non-Paris Club creditors proceed with it? In the same way we've been looking at their participation in the DSSI.
Very good. I don't know if anybody wants to jump in quickly on China and this. If not, I'm going to go straight with Professor Rim, just trying to understand more the practicalities of the platform in here. I was wondering, what is the governance structure of this platform? Who should host it, and whether data should be fully transparent?
Thank you, Alonso. Our idea is to have an independent structure. Means it has to be hosted in an independent institution, such like, for example, OECD or probably similar organizations who, in fact, are not lending to the countries. I think this is important to have an independent organization that has the capacity, one, to ensure the data is up to date, so they have the resources, and they have also the experience to ensure that these data is not misused or also protected and so on. So this is extremely important. Now, also what we have said in our piece is to have a private-public partnership, and you heard, the importance of the collaborative effort, because everybody, every lender, every less the borrowers, but then you need to enhance the incentives. And I agree absolutely with Moritz that you need to have the right incentives to ensure that the data is shared and the transactions are certainly registered. So basically, for the moment, what we as an academic institution and would like to see is more transparency on the data side, especially on the debt data side, to allow further knowledge, qualitative knowledge. And I agree absolutely also with Moritz that the next steps is to build indexes, and then to have more qualitative research on those aspects, not only from, of course, a legal perspective, because all of this will be linked to all legal aspects, which you mentioned, the research of legal experts on how to manage the structure and so on, but also from an economic and social perspective, because it's extremely important when you increase too much the debt level, and the cost of this debt would increase, to levels that are probably not easy for the next generations to pay it.
Very good.
Alonso, can I just come in quickly on that point?
Go ahead.
I just wanted to raise one consideration from the point of view of private creditors, that the legitimacy of the repository and its kind of international recognition and credibility, expertise in debt issues, is important, right? I mean, we considered a number of options for housing the voluntary principles for debt transparency, but legitimacy, so an international organization, an international financial institution, something like that, is key, because disclosures are sensitive, right? And as Thomas, I'm sure, can tell you, there are a lot of legal considerations about to whom you disclose the data and how you disclose it. So that kind of, as Rim mentioned, the credibility and legitimacy are very important.
Very good. Very good. The next question, I think I'm going to choose Moritz. Moritz, I was wondering, given your experience, how much of a problem is transparency for rating companies in Africa? And I'm wondering how this platform, this initiative, could change the rating models of some of these companies. And at the end of the day, could more transparency reduce this so-called African premium, even if the ratings of some of these countries don't actually fall or don't improve?
Yeah, thank you for that question. It's a very good one. It's actually two. First, one question you didn't put out, but I will chisel it out of your statement. The Africa premium is something that is much quoted, but I don't actually think it exists. I think once you put in the difference in creditworthiness and the difference in liquidity of those instruments, I'm not really sure there is such a big or any sort of extra yield, discriminatory yield, or colonial yield. Or, I mean, I've read all sorts of things. I sometimes reacted a little bit allergically to that, because I think it can be a little bit self-serving also, and trying to deflect sort of own responsibility. What is true, however, and I'm doing some analysis with some academics in the UK right now, it seems, trying to explain what have been the rating actions since the COVID crisis started in March, that African countries have been hit harder than what you would expect, and sort of highly rated countries were pretty much let off the hook. That's something that we're working on and trying to put a paper out. I think that is a remarkable observation, because you know, there seems to be a bias now, but you know, structurally, historically, I don't think there really was one. Is it important, transparency in sub-Saharan Africa? Absolutely. During my 18 years at S&P, I think the only ratings we ever withdrew for lack of data were all in Africa. Because the teams, you know, they change, and it's sort of the human resource level is very thin, and new people come in, they just don't take up the slack, and you know, they don't pick up the phone, and basically you don't get any information. So I think that African countries by and large do a comparatively poor job of managing this relationship. The data that you get is not very good. It's sometimes very late. I don't really think there is a other than South Africa, which is in a league of its own in many things regarding management, that there is a good example of how these processes are handled, how information is being provided. Sometimes because they don't have the information themselves. It's not that they hold it close to their chest, but the information basis is just so weak in the country that even with the best intention of sharing it confidentially with the rating agencies to do their jobs, they just don't have anything to share. And the country you usually reside in is sort of a prime example. I mean, Nigeria, in terms of data, is close to hopeless, really, I have to say. And clearly, if you don't trust the data very thoroughly, as an analyst, you have to give some allowances to it. And that's, I think, what is misrepresented sometimes as a discriminatory Africa bias. It's really the data is poor, and sort of the variance about what you think is really happening on the ground is wider than in other countries. You need to account for that. So it is a problem. I think the progress has been very patchy. It's been, you know, in all those years that I did this, has been much slower than I would have thought at the beginning it would be.
Very good. Maurice, I'm going to go now with Thomas. I know that he has to go. So, Thomas, you mentioned how the IMF proposal remains fuzzy. Over the last few years, we have seen more of these resource-backed loans from trading houses resurfacing. Usually they come to light when there's a problem. The IMF, in its proposal, they suggested including collecting auction clauses in non-bond debts, such as these oil for cash loans. I was wondering, from the legal perspective, how can you do that with some of these countries, when some of these companies are actually private companies? I'm wondering if you can tell us a bit more about that.
I'm not sure I fully follow the question, but let me have a go. So when I mentioned that the IMF's proposal was fuzzy, I was dealing specifically with their proposal on how they're going to use their debt limit policy in order to incentivize transparency. So those debt limit policies at their core limit the contracting or guaranteeing of non-concessional external debt when the country is receiving financing from IMF on a concessional basis. So it's not clear to me how that policy is going to be additionally specified in order to help with the specific issue with regard to transparency. What is clear from the IMF's recent paper is that they provide an excellent survey of many of the issues facing the sovereign debt restructuring architecture going forward. And what I draw from that paper is that there will be a phase that is now coming up where IMF financing into certain countries is going to become the core tool used in order not just to facilitate the debt restructuring, but also to facilitate private sector and other creditor participation alongside IMF financing. So if there's been any uncertainty as to what is being portended in that paper, I think it really will be clarified very soon, that the common framework is built around IMF financing. One point I would make that I didn't fully articulate earlier in my intervention, and I wanted to come back to it, is partly a timing issue and partly a tool issue. So at the moment, we're in the crisis containment phase. And for many of the countries that we've been talking about, they critically need concessional financing, highly concessional financing, in order to help them with their liquidity situation and to ameliorate the economic impact of COVID-19. So that is what they need in the short term, in the crisis containment phase. But going forward, one shouldn't forget that these countries critically need private sector financing in order to meet their development financing goals. There is no country that is going to be able to develop just based upon concessional financing for the multilaterals. And so what we need to be very careful of is to make sure that we can provide the remedial measures of highly concessional financing in the short term, but without losing the longer term objective, which is to keep these countries on track to being able to access private sector financing going forward, not just for the governments, but also for the credit-worthy corporates, also for the project financing. All of those needs cannot be met by the IMF or the World Bank, and should not be met by the IMF and World Bank. And so even though we can accept a short-term approach where the IMF has to come in order to help with the crisis containment in this phase, we want to make sure we don't lose the longer-term development objectives of these countries, who can only develop through financing, at least on a hybrid model, and ultimately on a model that is driven by private sector financing. So I think that's the big meta problem that I wanted to identify as being critically important underlying this discussion. Thank you.
Very good. Thank you, Thomas. We're running a little bit late, so I have two more questions for Funsho and Kwame. First, Funsho, I'm wondering now, we have seen the yields of some of the sovereign debt from Africa's drop after the crisis in March and April. I'm wondering what your expectation is in terms of, do we expect another issuance for this year? Can we have an issuance in Sub-Saharan Africa this year, early next year? And if we do have progress in transparency, do you think that we could have a tremendous increase in demand for African debt, given the negative returns that we see in the developed world?
Yeah, sure. I'll take those in turn. Thanks, Alonso. It's interesting because what everyone in the private sector has been waiting for has not been really a view on DSSI2 or anything like that. It's really been an idea for what the forward-looking projections are for these economies. And so the reason why the market has been able to gather around financing so far, we really think, has been that people have been trying to get themselves an understanding of what the medium-term outlook looks like, and trying to figure out what the fiscal space looks like, and whether or not, with the IMF and the World Bank over their shoulders doing their sustainability analyses, whether or not they're going to be going to the external markets and not be in contravention of whatever sort of non-concessional debt limits exist. So now we have this regional economic outlook. There's a call actually just a little bit earlier that's out today. I think you'll start to see finance ministries planning what they're going to do before the end of this fiscal year, some are in December, some are in June, and for next year. And so I think that's really, sort of slowed things down. That said, in all of our discussions, whether it's been in our collaborations with the IIF or even internally with the private sector, we are waiting to see who wants to borrow, who wants to come to market. The markets, as far as we are concerned, are open. And if you look at the likes of Kenya, for example, there is an intention to come to the market, or at least an implication that they might come to the market in the next few months. And when they do, the market at that point will take a view. So yeah, I think the market is kind of still open. And then on your point about yields and Africa, I think if we think about the constituents that fund Africa, let's think simply about the Eurobond space for the time being. There's absolutely been dried up potential, there's dry powder, sitting on the sidelines waiting to come in, because this is a year that without COVID would have seen a few $1 billion of some sort of issuance coming, and people would have been expected to deploy that capital into Africa in proportion to whatever the global benchmarks are. When I speak to our peers in the market, ourselves in the market, we have dry capital to invest. So now this is purely a basis of where yields are going to get to and whether or not we think they're sensible. And I'd like to agree with Moritz, at least some of Moritz's comments about the yield premium in Africa. There are some countries that are being priced at very, very attractive yields indeed, and some are, I think, very obviously being punished for not behaving themselves. But yes, I do think there's money on the sidelines. If Kenya, for example, was to turn up with a $2 billion or $3 billion bond in the next 8 months before its year end, I think they'll get filled, and I don't think that the premium they'll pay over the last time they came to the markets would be that significant.
Well, Funsho, thank you very much. Now I'm going to go with the last question because we're really running out of time, which is a shame. And this is for Kwame. I'm wondering, Kwame, if a platform like this can integrate compliance, if we can have a way of monitoring how this money is spent, I'm wondering what you think in terms of how this can change investors' view about these countries. And I'm not talking about just creditors. I'm wondering about real economy investors. How can that change the view about these countries? What do you reckon?
So I think I made that point slightly, and I'm sure that's why you're asking this question, which is the use of the funds if they are tracked. And so I think how to do it will be, number one, to have some agreements as part of the financing to ensure that that use is tracked and monitored in an effective way that's not too cumbersome. But I think for investors, they'll have more comfort because this whole risk premium thing must be explained. I mean, and that's the point that was made earlier. It must be explained properly in a practical terms to say, why is there a risk? Is it only because of how the debt is managed? And a critical component of that is really about the use of it, which is typically not really viewed. So yes, I think for investors, they'll have a more accurate view on how things work, and it will definitely go to improve the overall debt management process. Thanks.
Very good. Well, thank you very much. I think we're really running out of time, but I'm wondering if maybe Professor Rim has any final words to close this up.
Yes, first of all, I would like to thank you for moderating this panel. It was really great, and I think we have learned from different perspectives. And I think for this debt transparency, I can see that there is a role for international organizations in close collaboration with the Paris Club creditors, but not only Paris Club creditors, also creditors like China and India and others. Also the private sector that need to be really consulted and not only consulted, not just to apply mechanisms on which they have not been consulted. I think this is also important to have a transparent consultation process on the dynamic of restructuring or eventually default. Of course, if there is probably not that risk of default, we could eventually solve the problems earlier within a clear and orderly and organized restructuring and resolution mechanism. So this is important as well. But also, I think data is key. I think we need more granular data and time data. So not just 1 year ago, but we need to have new issuance. And this is extremely important to make your risk assessment. Obviously, in my view, but more research has to be done. More transparency would have probably positive implications on risk premium. Probably the risk premium will go down over time if you are more transparent. So that's why indexes and monitoring indexes is essential. But then, of course, we need to have a robust index. And I think this will allow, obviously, the index to be adopted by market players, I think, to be used for the monitoring process. Now, monitoring proceeds is key. And obviously, in this platform, we would like to see more disclosure on the use of proceeds. It won't be easy. It's a complex issue, but I think Moritz has provided very interesting proposal, incentive to probably rethink the pay of the public officers. Obviously, you need to have a political will to do it, because these are local issues. You cannot impose it via clauses or international clauses of restructuring, whatever have you. But then one other very important aspect is the subordination. I think unreported debt has to be subordinated. In my view, this is an important incentive in the market. Also, in the contractual obligations, more reference to monitoring. It's very important, because I think transparency would, for sure, will have implication on recovery rates. So if you know more, you might even collect more in the restructuring phase later on. But then I haven't seen research that shows that, so we need to do more research for it. And that's why what we have done in this initiative, which I emphasize the support from TIA Capital, colleagues from TIA Capital, because they shared also some data and they supported this initiative. We, as EMEA, Euro-Mediterranean Economists Association, were happy to donate this pilot project to whoever is wanting to host it and really to make it happen. I mean, it's our little contribution as an independent think tank or research organization to make it go faster for the African countries. And not only Africa, yeah, I agree, it has to be a global initiative, but at least our focus is on the continent and countries that are really need this transparency. I'm not talking about the governments themselves, but really the citizens, the civil society organizations, and all the future generations, which we need to think about them today. And clearly they need transparency, because all the actions and the decisions that have been taken today to over-indebt the country, somebody has to pay it. And this will have ramifications on the socioeconomic implications for those countries. So we need to be wary of that, and we have to think about it from now. So with this, I would like to thank you again, Alonso, for the great effort. And we're very happy to have you with us today. All the panelists, starting by Sonja, but she left, so I'm very happy to have her, and the IAF also supporting this initiative. This is a very important support for this. And Funsho from TIA Capital and all the colleagues who have helped the co-organization of the meeting. Moritz, for your great support and very great ideas, and I hope we'll continue working together on this very thorny issue. Kwame, I'm sure there is a great role for audit firms and companies to contribute to this very important exercise upfront, and maybe also ex post in the monitoring. Also, it's not only it's also on the ex post part of the dynamic. Again, as I said, I hope I didn't forget, and Thomas, I don't see Thomas, maybe he left, but also Thomas has made a very important contribution today, and I'm sad not to have my colleague Emilios. I hope things go well with him, but certainly we, academic community, we are committed to continue researching and doing work, and hopefully contributing to this very important development on debt architecture reforms and debt architecture. So I think with this, I think we are right on time. There are a few other small things we will do. One is a survey, so please, Kinga, show the survey, and then please stay on the screen, because we will have a group picture of all the audience, who I thank very much for bearing with us 1 hour and 50 minutes. Thank you very much. And then again, I'm very happy if you can respond to this short survey of satisfaction, so we continue improving our events and activities at EMEA.